Hello guys, and welcome to another develop video. Today we're going to take an in-depth look at CrowdStrike Incorporated, AutoZone Incorporated, and Target Corporation. First, we'll start with CrowdStrike Holdings Incorporated, an American cybersecurity technology company based in Austin, Texas. It provides endpoint security, threat intelligence, and cyber attack response services. CrowdStrike is, I think you've heard of it. It's a very known stock, a very known company. Many people know it from the 2024 incident that took place about 3 months ago, I think, or 4 months ago, when a lot of computers worldwide basically stopped working because of them. And as you can see here, the stock price dropped dramatically. But since then, their stock price has increased considerably, and that's why we're covering them today to see if they are a buy. Now, first of all, let's look at the business metrics. We can see a negative ROIC and a very low ROE. This is because they've just recently turned profitable. Their current ratio is 1.76, so they have good short-term liquidity. Now, as for their valuation, their free cash flow yield is 1.33%, so they're very overvalued, and their price to earnings is 764, so they are insanely overvalued from this point of view. Now, I use grams valuation using a revised formula. This gives us an intrinsic value of $88.23. Now, I also use the discounted cash flow. As you can see, minus 64 million free cash flow in 2017 to 929 million in 2024. So this is really good. I use the 20% growth rate because based on their uh, growth rate since they became profitable, this is realistic. Um, I do not use historical multiples and neither multiple valuations. They and the dividend discount model does not apply here because they do not have dividends. Using the average above valuations, we get an intrinsic value of $158. Applying a 15% margin of safety, we get an acceptable buy price of $134. Now, CrowdStrike is definitely an interesting company because of their huge growth rate. Uh, but the big problem here is, of course, that they're very overvalued. I don't have a problem with the company. It's just that they're very overvalued. And yeah, if they ever drop to $150, or actually, I don't think $150 is. You can buy it at $200 depending on how you do your DCF. You can do your own DCF analysis because DCFs are very complicated. Since technically speaking, you can just calculate just put in the free cash flow and then calculate the growth rate, but that is not necessarily the correct way because you have to calculate all variables. For example, when I do my DCFs, I calculate the stock compensation as growing higher than operating cash flow. I calculate decreasing gross margins all the time. So you have to use conservative um, measurements in your DCFs to get a good valuation. Now, second, we'll move to AutoZone, another known company, although not actually not as known as CrowdStrike. AutoZone is an American retailer of aftermarket automotive parts and accessories. It is pretty popular. It is not necessarily the best. It does not necessarily have the best service, but it is pretty popular. Now, let's look at the business metrics. Their return on tangible assets is 16%. Their return on invested capital is 34%, which is really good. The return on equity is negative, but this is for a good reason. They do a lot of buybacks, and because they do a lot of buybacks, their treasury stock is very high. So this artificially deflates their equity, making it negative. Their current ratio is 0.84, which is okay, but it could be a bit higher. As for valuation, the free cash flow yield is 3.51% and the price to earnings is 23. So both showing a moderately high valuation, not too crazy, especially in today's market. As for Graham's valuation, let me see their okay, so it's 22.84, we get an intrinsic value of $545. But to be honest, sorry, not 22, 152.93, and this gives us an intrinsic value of $3,588, so slightly higher than today's price. And the discounted cash flow model will use so let's see, a 9.5% average. I think a 5% average is okay, because now, technically speaking, I should use a higher growth rate, but the fact that their business has consistently declined in the past 3 years, and their estimated earnings will continue to decline, means that even 5% is not necessarily probable. I'll just use 5% because it's half of their average growth rate. We get an intrinsic value of $1,565 per share. Now, on the output, calculating the average, the intrinsic value applying a 15% margin of safety, you get an acceptable buy price of $2,190. So well below the current price. AutoZone is a bit of an interesting case study because, technically speaking, they're a very well managed company, especially in terms of buybacks, but their business is just not a quality one. So the fact that they have declining free cash flows and their earnings are projected to decline means that the underlying business is not that great. Also, I've seen many people complain about AutoZone. So this is not a quality business. They may have quality management in terms of rewarding shareholders, but there is not much to reward shareholders with in a dying business. Until now, it's been a great business, but it's declining, and I do not see potential here. I think it's a buy under 2000, in my opinion. If you manage to get it under 2000, okay, you can do it. If you don't, I don't suggest you buy it. But of course, do your own due diligence first. Do not just go on YouTube and buy whenever you see a YouTube video, or sell when you see a YouTube video criticizing a company. Next, the last company actually for today is Target. You must have heard of Target. It's pretty popular in the United States. If you're not from the United States, maybe you haven't heard of it. Target Corporation is basically an American retail corporation that operates a chain of discount department stores and hypermarkets. And it's a very large retailer in the United States. Their business metrics look pretty good. They are, especially for a retail corporation. Their return on invested capital is 12%. Their return on equity is 31%. Their current ratio is 0.91, so pretty good short-term liquidity. Their valuation is average, to be honest, for a discount store. It's not special, although compared to the market, it looks good. It's not that special. So 5.68% free cash flow yield and a price to earnings of 13. Let's do Grant's valuation pretty quickly. Their estimated earnings per share, 8.69. We get an intrinsic value of $203. So well above the current price. And the discounted cash flow, we see here that their free cash flow has been basically the same. Well, it has grown, but it grew in 2015, but since then it has stayed the same. So I'll just put it at 2% growth rate in line with inflation. I think they deserve at least 2% growth rate. So we get an intrinsic value of $96. Now the dividend discount model, if their free cash flow grows at 2%, their dividend, of course, only grows at 2% because it's stupid to increase your dividend at more than your free cash flow, because then you run out of money to pay the dividends with. And doing the average of all three, we get an intrinsic value of $125. Applying a 15% margin of safety, we get an acceptable buy price of $106. So Target Corporation, as you can see, is trading at very close to intrinsic value. And I think, as I've said, this is a retail business. The valuation is nothing special. This is why they're trading. So they're actually trading at intrinsic value. So their valuation is not extraordinary. Just because they have a 13 price earnings doesn't mean anything. It depends on the business, it depends on the growth profile. So this is why you don't necessarily compare a business to the market. You don't compare a specific company to the whole market. You just compare it to the industry that you're thinking of. Yeah, I think Target Corporation is not a buy. Um, Retail in general is a pretty bad business. Warren Buffett has always stayed away from it. Only Costco, to be honest, has been a great investment. All the others have been pretty trash. I do not think Target is any different. It's just a trash business. It's not good for any value investor. It's not trading at a discount. It's not a quality business. It does not have any underlying growth potential. Yeah, there is nothing to see here, to be honest. This is all that we can talk about Target Corporation. Uh, yeah, if you want to buy it, you should buy it. But if you don't. You should do your own analysis. If you find something that I didn't, please comment it down below. Maybe find a catalyst for growth, but I do not think so. Yeah, this has been it for today. To end our video, let's talk a bit about our affiliates, Ticker Data. Ticker Data is a tool I use for this video. So you see this whole template. This is from Ticker Data. You see this ticker symbol here where I get all the financial data in real time. This is Ticker Data. So I suggest you check it out in the link in the description below. I think you'll love it. Also, do not forget to check out my investing blog from the link in the description below. I'm currently working on an interesting article about the current market variations. I'll post it, I think, in 1 week and a half or 2 weeks. I think you'll love it, but we'll see. This has been it for today. I hope to see you in the next video. Bye.